that. So let's kick off. Good evening, everyone. Today, we are going to discuss a topic many investors would think at some point. That is how to spend their portfolio. One of the key consideration at that stage, which is what is the best structure to use. It can be under personal name, it can be under SMSF, or it can be trust. And in this webinar, we're going to touch all the three structures. As many of you are aware, we hold a webinar once a month, and our past webinars have been well received. Attendees have found them very valuable as we always share real insight, real examples, some learnings from our past experiences. If you missed any of our webinars, recording is available on our website and it can be accessed at any time. Dinesh, can you move the next slide?
Yep.
So this is our table of content, what we're going to cover up. But before we begin, let me share some housekeeping rules. As usual, this webinar is going to be recorded, which has already been recording, and we will be sharing the recording afterwards. Please be on mute when speakers are presenting or discussing. Q&A will be at the end, but feel free to drop any question in the chat box. My suggestion would be ask a question which is aligned to this topic. The topic is about structures. We are a buyer's agent. We are a broker in this particular webinars. So there might be some questions which might be answerable by accountant or financial planner. Just an FYI, we are not that. So we will be answering those questions which aligns to what we does it. General note, we have received many questions during registration. A lot of generic questions have already been answered on PFA across different threads, but we will still cover as many as we can towards the end of this webinar. Dinesh, can you move the next slide? A general introduction about Prop Expert, about the speakers. So in this webinar, there are three speakers: Amol, who is a mortgage broker, Dinesh, and myself. I will start doing an introduction about myself. I'm one of the directors at Prop Expert and also a buyer's agent. Many of us also know me through the PFA group, which was started back in 2019. It has reached to more than 68,000 active members. Since the start of this group, I have answered thousands of questions on PFA, but I would like to share a proud moment. We have been nominated in finalists in the social impact and awareness category, for which the award ceremony will be held at the end of this month. Who knows, we can be winner over there. But as a buyer's agent and as an active investor since 2009, I focus on understanding each client situation and guide them with the right strategy to help them buying in emerging markets. So far, I have been involved in over 300 property purchases through Prop Expert, and I will continue to do the same thing for the other people as well. That's a small intro about myself. I'll pass on to Dinesh to introduce himself.
Yeah, Manish has covered that bit. So we started literally 4 years ago. Myself as an investor 6 years ago. In 6 years, I started just with $30,000 where I bought my first property. And then I used equity to buy multiple properties. At this stage, I'm sitting with 9 properties. I've used I've bought properties in trust. I've bought properties in SMSF, bought in a personal name. So I've scaled my portfolio from 0 to 9 properties in last 6 years. And with Prop Experts, as Manish said, like we help more than 300 clients now. Majority of the people buy properties in SMSF and trust. So we are the people who guide you on a high level to go to the accountant and other professionals and decide which entity is best suitable to you, right? So we have, like, not only me bought 9 properties, we have clients in our business where we bought 8, 9 properties for them, and not one, multiple clients, right? So we're known to build portfolios, and that's what the experience we have, right? Our vision is to be one of the leading buyer agencies in country in next few years, and we are tracking well for that, right? Awesome. I'll pass on to Amol to give some intro about himself.
Perfect. Thank you, Dinesh and Manish. I'm Amol Kuntale. I'm the director of Ask Financials. I hold a double master's degree in accounting and financial planning, as well as I'm a mortgage broker. I've won the Broker of the Year with 𝐓𝐵𝐴, and I'm one of the top 3 brokers with AFG across Australia as well. I personally am a property investor with 10 properties in my portfolio. So I help the clients to scale their portfolio without exhausting the borrowing capacity. So my niche is investment space. So most of the clientele that we have are the investor clienteles.
Thank you. Before we move further, and as we are touching the structures, I would like to read down this particular disclaimer. This is a very big disclaimer. So full disclaimer is on the screen. I will read down the smaller version. This webinar is for general information purpose only, and it does not provide any information related to financial, legal, property, taxation, or accounting. Please ensure you seek independent advice from a qualified professional before making any decision based on the information shared today. Now, as we had to touch these structures, we need to understand the pros and cons. Let's hear from Amol about what these structures are. Over to you, Amol.
Thank you, Manish. Okay, the structure trap. The common mistake that a lot of people do is that they just concentrate on the immediate property and they don't think about how this particular purchase is going to impact their future purchases. So it's important to have that end goal in mind, and then we reverse engineer. Based on that, we decide what the structure is going to be. And the common mistake that people do is that they just concentrate on the immediate property. And as you can see from the stats, that 73% of the investors only are stuck on the one property, 17% of them are stuck on two properties. There's hardly very small percentage of the population which hold more than two properties. So structure is the most important part when you're building the portfolio. Dinesh, do you want to go on next slide? Yep. So the hard truth, most investors pick a structure based on what their mate did. That decision will cost you thousands of dollars. So wrong structure, wrong tax. So depending on what your income is, if you are going to purchase a property, for example, if it's a positive get property and you're sitting on a 47% tax rate, you will be taxed. Second is the wrong structure, lost equity. I've seen a lot of people purchase multiple properties in the same trust and equity gets locked out or they cross collateralize. So having that wrong structure can cost you a big amount. And the last one is the wrong structure, no protection. If, for example, if you're a solicitor, doctors, medical professionals, where protection is most important thing, going into that trust structure is most important, because buying that under personal name, you are open for that lawsuit. Cool. So today what we're going to do is going to discuss about this three investment structure: buying it under your personal name, buying under trust, and SMSF. So the default one is going to be buying it under your personal name. So especially when you're buying your first property, again, it depends on what your goals are, end goals. But usually if you're on a decent income, we go for your first property under a personal name. It's the simplest setup structure, no complicated ones. You get the full negative gearing benefit and there's no ongoing compliance cost. What you need to watch out for is if the property is positively geared, and if you are on a high tax rate, you will end up paying a higher taxes. Second thing is if asset protection is the priority for you, so you will not have any asset protection if you buy it under your personal name. Buying under the trust structure, it really helps and makes sense when you want to distribute the profits to your spouse, to your kids. And second is the asset protection. Again, you do get CGT discount, which is under the personal name as well, if you're holding the property for over a year. And the important thing is the estate planning. So for whatever reason, if you pass on, it becomes easier to pass on the property to your immediate family and kids. Whereas under personal name, you have to write in the will and then it goes to the probate thing. What you need to watch out for is the negative gearing. So negative gearing gets trapped in the trust. You still get the negative gearing benefit when you sell the property, say after 10, 15 years. But whereas under personal name, you can claim all the tax benefits on a yearly basis. Higher setup and accounting costs. So you to set up the trust plus yearly basis, you have to pay the accountant fee. And a third one is the land tax. So certain states may charge you a higher land tax under the trust. Third one is your SMSF. So SMSF, the good thing is that it's a flat rate of 15% in your buying period, accumulation phase. And when you are in your pension phase, there's a zero CGT. Even if you sell the asset after your pension phase, you pay zero CGT. That's an amazing thing. Commercial properties, you have the option to lease it to yourself, not the residential, but the commercial property. So you have the option to lease it to your own business. And what you need to watch out for, the ATO recommendation is 200,000, although I personally have started my SMSF journey at 110,000. It's a highly regulated industry, so the compliance is very important. Always seek guidance from your accountant and a financial planner. And the important thing is that the residential properties, you cannot use it for your personal purpose or even your immediate relatives.
Just want to touch base with everyone here. Whenever we are talking about trust structures here, we are mainly covered family discretionary trust into this topic. There are multiple other trusts available like unit trust, and there are a few others as well. So yeah, for a right guidance for what structure is best suitable for you, is you have to go to accountant and discuss, because we've been seeing people buying in unit trust, and but most popular one is the family discretionary trust, which the most of the content will be covered on that today, right?
Perfect. So structure number one, personal name. When does it work best? If it's going to be your first property, simple structure, no tax complicity. If you're holding the property for more than 12 months, you will get that CGT discounts. And the lending side, it's a pretty vanilla deal. So most of the lenders will lend you when it's going to be under your personal name. So it works really well for the first home buyers, single property investors, those kind of things. What you need to watch out again for is the 47% tax rate. So if you're on a high income and if the property potentially is going to be positively get, you need to make sure that you're buying under the right entity or structure, not under personal name. All the debts sit under your personal name, whereas under trust, you have the option to exclude it. So after 2-3 properties, you potentially will hit your serviceability roadblock. So you have to take that into consideration. As I said, harder to scale past 2 or 3 properties. So you have to take that into consideration. No income splitting. So it's like if you're buying it with your spouse and if it is 50-50, when you sell it, you're going to get charged CGT and all the taxes 50-50. So you cannot split it. Well, can you split it? Yes, but there's going to be a cost for it. Asset exposure. So if it's going to be under personal name and there's no asset protection if you buy it under your personal name. Okay. Cool. Going on to the next one, which is family trust. As Dinesh advised, we are going to cover the family trust today. So think this trust like a bucket. So you're holding this asset in the trust. At the end of the year, if the trust is making the profit, you have option to distribute the income to your spouse, to your kids, whoever you want to. It's your discretion. So this year, for example, your spouse earns less, you have the option to put 80% under her name. Next year, if you are not working, you have the option to take more profit. So it's your discretion. That's how the family trust works. So trustee controls it and beneficiary receives all the income or dividends. Now, what you need to watch out for is it's a legal entity. The trust is not a person. It's a company. It's a legal entity who owns the property. Beneficiaries can be a person or a company, and the trustee can again be a person or a company. From the lending perspective, most of the lenders need the trustee to be a corporate entity rather than a person because it defies the purpose of going under trust. Now, just want to cover quickly on the unit trust. So with New South Wales and South Australia, a lot of people go for unit trust because the land tax in unit trust for these 2 states is 0. Whereas family trust, you may end up paying 6 to 8 grand. So what you need to do is first, you need to decide which state you want to purchase the property. Then speak with the accountant, have the right structure, and then get your loan approved. Cool. Trust deep dive, when the trust works. So if you are a high income earner, when you have the spouse or kids or adult kids who are on the low income earner where you want to distribute those profits, when the property potentially is positively or neutral get. Now also you need to understand in the current market when the interest rates are so high, your property is going to be negatively get. But we are holding the property for long term. After 2 years, 3 years, when potentially there will be rate cuts, when your rent is going to go up, and if the property is going to potentially turn positively get. So although it may be negative grade right now, but if in the near future, if it has the potential to grow positive, we'll still go under trust. And the last one important is the professionals who want that asset protection. When does the trust doesn't work? So heavily negatively get properties, no beneficiaries on the lower tax brackets, the short-term flip strategy. Again, you may end up paying a huge taxes on that. And because it's an ongoing cost, especially the accountant and the compliance cost. So if you cannot afford that, you shouldn't be buying under the trust.
Amol, sorry, I have to interrupt you. I have a very good question because that's one of the questions which has been asked to myself a lot, right? And it comes on the PFA as well. So
Yeah.
Because you're touching the first, I thought to ask you now over here. When it comes to expanding a portfolio and for those considering buying property in a trust, do they typically buy one property per trust or they add up another property, another trust when they add another property?
Very good question, Manish. So it all depends on your borrowing capacity. So there is no hard yes or no rule. If your borrowing capacity is pretty big or good, you have the option to purchase multiple properties under the same trust. But always remember, keep the breathing space in that trust because tomorrow you want to extract the equity to fund your next purchase as well. A lot of people, I had a client where his earlier broker had 4 properties in the same trust. He was sitting on a 500,000 equity, but there was no borrowing capacity in the trust. So So you're just locked into it. He was forced to sell the property, which that's the worst situation to be in. So always make sure that you have enough breathing space for you to extract the equity. And from the refinancing perspective, you want to make sure that you're not locked with that particular lender. It should become easier when you want to refinance. So if your borrowing capacity is sitting around that 700, 800, 900K under trust, one property, if it's sitting around that 1.5 millish, you have the option to go for 2 properties or more.
Awesome.
Thank you.
I want to add another question here, just to, so we discussed the personal and the trust now. So if I have a young professional, like literally 3-4 years in the career, they have an income of 120, 130K, single at the moment. So for them, if say the person is a property enthusiast and want to build a portfolio, what is your recommendation how they kick off their journey? They should go with a personal name first, or they should go with the trust structure?
So there are a few multiple factors that we have to take into consideration. Do they have any plans to purchase an owner-occupier in the near future? Are they going to get married, or is it going to be just single income? Considering that it's just a single income earner, and if they have plans to grow the portfolio to 6 to 8 properties, purchasing this first property under personal name is going to kill the borrowing capacity, and it'll be very difficult to grow the portfolio. So what we do is we go under trust lending from the get-go, and we grow the portfolio. The last property, potentially he has the option to purchase it under his personal name. So it all depends on what the goal is, what his personal circumstances are, and how many properties he wants to grow in his portfolio. So rule of thumb, again, whatever your total income is, into 5.5 to 6% is what bank will lend you. So if he's on 100,000, bank is happy to lend you 550 to 600,000. For 600,000, if you're going to purchase one property under personal name, you will max out. So we go under trust.
Yes. So why I'm raising that, we had scenarios where the young professionals come, and few of them, they use the right structures from the beginning. Now they're sitting with the 4 and 5 properties. One particular case, she's sitting at 1.5 million equity in 4 years, right? But very, very, very good thing that if you start with the right structure, right, your portfolio can be definitely to a next level, right? Yeah, that's good. Going next.
Cool. Self-managed super fund. So before I start on self-managed super fund, it's a highly, highly regulated one. So please make sure that whatever you do, always take accountant and a financial planner guidance before you do anything. Okay, cool. So what is SMSF? So basically what happens is industry super funds, they invest it on your behalf. Self-managers, you have the option to invest in properties, in shares, in crypto, in different assets. So you have that control. Again, as I said, it's a highly regulated one. So you get audited on a yearly basis. So make sure that you don't use it for your personal, gains or anything of that sort. So you have the option to go for 6 members into the SMSF. So you have the option to go with your family, with your friends, and all the things. Trustee, potentially it is going to be you who acts as the trustee. So there are some strict rules. So this particular fund is for your retirement and not for your daily ones. So using it for your personal assets, it's completely prohibited, including the property. Cool. So the 6-step LRBF, which is limited recourse borrowing arrangement flow. So step 1 is establish your SMSF. And so it depends on the lenders, or most of the lenders require you 20%, and it also depends on the type of asset you're purchasing. For the commercial property, potentially you will need a little higher deposit. For residential, you have the option to go for 10 or 20% deposit. Create a bed trust. Bed trust is the one who is going to hold that particular property, and that's where your assets gets protected as well. Again, your solicitor or an accountant can create a bed trust. Third one is get your SMSF loan. So now here we are dealing with the tier 3 lenders. Earlier, 10 to 15 years back, all the tier 1 lenders used to do this SMSF. They've ceased it. All the tier 3 lenders are doing it. So it's important to get that pre-approval. Now, important thing to talk about how the servicing works under SMSF is they don't look at your personal liabilities or anything of that sort. So there are 4 factors. Number 1 is your mandatory contribution, which your employer contributes, which is minimum 12% of the salary. Second one is additional or concessional contribution. So you have the option to contribute up to $30,000 per person. So between you and your spouse, you can put $60,000 and you can backdate it for the last 5 years. So this is a gray area where we can use it to increase your borrowing capacity plus bump up your super balance. Third one is the rent you get in your super, and fourth one is your CMA balance, which is your total super balance. So based on that, lenders to calculate your serviceability, and we can purchase the property. Fourth one is then purchase the property. Fifth one is the rental income. So you need to make sure that everything is separate. You need to create a separate bank account. All the income comes, all the expenses go out from that. The file gets audited on a yearly basis, and the loan is repaid.
Amol, sorry, another question I have it in my mind. Since you touch base about the loan part, right? For SMSF, I've always hear or something was in my mind like lenders normally lend up to 80% of the loan of the property value. Are there any other lenders at this stage where they offer 90% of the property value?
Yep. So there are. So again, see, in the SMSF space, we're looking at 8 to 12 lenders. Okay, so that's not huge list of lenders, but there are just a couple of lenders who will lend you above 80%. There was a promotion going with the paper money that we can go up to 90%, and there is no LMI as well. Now, you also need to consider we are paying a higher interest rate, and the moment you go above 80%, the interest rate shoots up significantly. So ideally, it's better to have that 20% deposit, but there are still lenders who will lend you above 80% as well.
So pretty much we can say that we need to do a forward planning in a way where the 80% or 90% will suit under our scenario.
Yep.
Reason is that because in the future, if you want to add up another property with an SMSF, right, then it is 80 or 90, it can help us a lot.
Absolutely.
Thank you.
Perfect. So the key mistakes in the SMSF that you have to avoid is, number one is wrong name on the contract. Some state, especially your Queensland, WA, Northern Territory, if you get a wrong name on the contract, it can cost you a lot of money. So it's important that you double check with your broker, with your solicitor, make sure that the name on the contract is correct on your bare trust as well as the contract before signing it. Number two is using the property for your personal use. So as I said, if it's a residential property, you cannot use it for yourself or even your immediate relatives. Number three is funding improvements with the borrowed money. So there's no construction is allowed. If it's a one-part contract, which is house and land package, that is still allowed, but there is no other constructions or any improvements which is allowed under the LRBA rule. Fourth one is no liquidity buffer maintained. So if you miss the payments under your SMSF loan, the lender can appoint a receiver over the bare trust. So some lenders have the liquidity policy, some lenders don't have the liquidity policy. Now, what is liquidity? So, for example, if you purchase a 600,000 property and some lenders, after you purchase, they need 5% of the loan amount or the property price as the liquid funds kept in your account. So for 600,000 property, we need to have $30,000. So, and for a few other lenders, they don't have any liquidity policy, but you need to make sure that you have enough funds just for any emergency purpose and to not default on the repayments. Fifth one is below market rent on the commercial. As I said, for the commercial property, you have the option to rent out to your own business. But if it is going to be below the market rate, then you will be taxed at 45% and you will lose that 15% benefit. The last but most important thing is not getting independent advice. So using your accountant, solicitor, broker as a team is good, but doing it by yourself and not getting a proper advice can land you in a bigger problem. So it's always important. As I said, it's highly regulated. It's important that you get that proper advice. Cool. Going to the next one. So how the borrowing capacity gets impacted under the each structure. So maximum LVR under the personal name, we have the option to go up to 95%, including the LMI. Trust 80 to 90%. As I said, there are a few lenders who will lend you up to 90%. SMSF, again, it's between 80 to 90%. Only a couple of lenders lend you above 80%. But for commercial, it is going to be lower LVR. Interest rates, it's a standard variable and fixed rates, which is with most of the lenders. Under trust, most of the lenders have the same rates as personal. It's just there are a couple of lenders where they will charge you higher interest rates under trust. SMSF, the rates are a little higher as compared to your personal and trust. Serviceability, it's a standard serviceability. Trust or the company ones, lenders do have the option to add back the distributions. And under trust, your borrowing capacity actually goes down because they don't take the negative gearing into consideration, which impacts your borrowing capacity. For example, especially with the big four banks, for example, your borrowing capacity under personal name is 800,000. Potentially, your borrowing capacity will under the trust will be around 650 to 600,000. So it drops down by 100 to 200,000. SMSF, as I said, that is very specialized lenders, so there are only a handful of them. Guarantor options, so yes, under the personal name you have, under trust you act as a guarantor, and the SMSF you don't. Cross collateralize, I personally recommend all the clients that do not cross collateralize, but you have the option under personal name as well as under trust. Under SMSF it is not allowed. Refinance is it's very easy to refinance your personal ones. Trust, it depends on how many properties you have, so it's moderate. SMSF can be difficult because there are some really high exit cost. Pre-approval speed, again, under the personal name, we are dealing with the tier 1 lenders. It's pretty fast. Trust, again, it depends on the lender. As you know, the trust lending is changing rapidly. Earlier, it was all the big four banks who used to do. Slowly, they have changed all the rules under the trust one as well. It's getting difficult with the tier 1 lenders. They are changing the rules, but the strategy still works because the tier 2, tier 3 lenders options still exist. Same thing happened 10, 15 years back when all the tier 1 banks used to do the SMSF. They seized it. All the tier 3 banks have taken over it. So that strategy still works. SMSF, again, we're dealing with the tier 3 lenders. So highly recommend to get the pre-approval, and the timeframes are a little higher as compared to the tier 1 banks. Cool. Manish bro, do you want to take over?
Sure. Thanks, Amol. And I believe you have, I'm sorry. What I want to say was that, like, you have given a great thing about the different structure, and I believe many would be able to understand what's the pros and cons, how the lending works for the different structures. But at the same time, from the cash flow, as a buyer, when it comes about to buy a property either in personal name or under a trust or under SMSF, we need to consider cash flow. Why the cash flow? Because the interest rate, as you mentioned, Amol, it will be different. Expenses can be different, right? The tax rate can be different. So from a buyer point of view, it's very important to understand where we are. Do we need to consider personal? Do we need to consider trust and SMSF? Let's take an example about how the cash flow will look like. A property has been, let's take an example with a property which we're going to buy for 700K. It's giving a rental for 600 per week. And now let's see how the numbers looks like. So that's one of the cash flow which is done on the screen. We have put some numbers in terms of the expenses, very conservative numbers we have taken it. Like when we have to do for the expenses, let's take the high expenses. So over here, 700K is the purchase price. 80% is the LVR, which means the loan amount is 560K. Given we are buying under personal name, the interest rate, I've kept it as 5.9. For a state, I'm just consuming that property management is 7.7%. Tax bracket, it can go a bit higher, but I'm just considering 37% tax in this scenario. On the middle side, there are expenses like insurance, rates, some leasing fees, some maintenance amount, which has been considered per year. Given on this scenario, and if we have a 600 per week, if this property is producing 600 per week, what we see on the right side, pre-tax, the person will be negative by 13,886. This will be how the cash flow will look like. In terms of the yield, is coming at 4.46, which is great. But yes, the same property now, when we see under the trust, the numbers will look different. How it will look different? Let's go on the next slide. Over here, there's some changes has been done. Number one, the interest rate, which was 5.7 under personal name, it has gone slightly higher for trust, is 6.2. The tax bracket, I mark it as a 0 because we know all the losses always stays inside the trust. So there's no tax benefit, right? They have been considered about something about 2,000. Why? We need to consider a trust setup fees. There will be a yearly audit fees, ASIC fees, right? So all these things has been considered as 2,000. Under the another option which I've kept it as other fee land tax 2,000. Why? If in some states, like for example Victoria, if you buy a property under a trust, land tax can be slightly higher, right? Given the expenses are higher, the interest rate is higher, there's no tax benefit. If you look on the numbers, the pre-tax will go a little bit higher. Where it was 13,000 something, now it has gone to 16,566. If you look on the post-tax, because there are no tax benefits over here, it's something which stay as is, right? So this is something which will suit for those people who want to buy, who want to stay, who all the negative getting should stay in that particular trust, right? Now, when we look and when we do a comparison with an SMSF, let's see how it looks like. The interest rate, which was 5.9, which was 6.2 in other scenarios, in SMSF, the rate of interest is always higher. So in this example, I'm taking 7%. The tax bracket, it will change. Like if we are in the acquisition phase, it will be 15%, right? The land tax and the other phase, I have put a little bit higher. Why? In SMSF, we need to pay a yearly audit fees, which comes as 2,500, right? All other factors are keeping it similar. But if you look on the cash flow, over here, most of the cases in SMSF, there's no option for interest only. We need to consider the P&I component, right? So this is something which comes up at 27,000, right? So depends upon the personal scenario, personal goals. We need to consider cash flow. Based on the cash flow, we need to take a decision which particular structure can be good for them, right? So these are the cash flow, right? Let's look on the next slide, right? Now, we know there is a cash flow which will vary from a particular structure, but these cash flow will also help us to understand what type of property we need to purchase, right? The property purchase can be different from a personal, from a trust and SMSF, right? For personal, if you're buying a property under personal name, we can buy any property, whether it's old, whether it's a new, whether it requires renovation, it doesn't require renovation, whether it has the potential for the subdivision or not. We can buy any sort of property as long as it aligns our goals. But when it comes to a trust, as losses stays in the trust, right? My recommendation is that it's always good to buy properties that's high in cash flow. Examples can be rooming house, it can be dual properties, or the properties with a granite flat. Or we can also explore the option for a unit trust, where if you're buying a property where we're gonna do a subdivision, we're gonna do a knockdown, where after all the build has been happened, we can sell it off. So that's an edge case scenario for the unit trust. But when it comes for SMSF, my suggestion is always that we should buy those properties which require low maintenance. And why is that? If the property is requiring high maintenance, that maintenance amount has to be pulled from your SMSF, right? Which means the SMS balance can go low. And ideally, we should not want to do that. So in short, property selection and the cash flow, they go side by side, and we need to think both of them before we take a decision what structure will be good for us, right? I have covered this particular part of the property selection, but I think there's a lot of questions will be in the mind, like how this structure will look like. Is there any real example? We have a real example over here. Dinesh himself has bought multiple properties in different structures. So let's hear from Dinesh.
Yeah, so I'll share the whole journey, how the reasoning behind that, and how I have done that from the scratch, right? So the first property when I bought owner-occupier, and there was a lot of grants at that time. It was just COVID hits. They came with the $25,000 home builder grant, $10,000 first home buyer grant. So I've utilized all that and bought my first property in Melbourne. That's where I'm living at the moment. And then because I was preparing myself to build the portfolio, I was starting getting education, understanding the trust structure. There's a bit of material out there where you can, like, I started absorbing all that. Then I realized that I have a borrowing capacity to buy 2 properties from here. And then the very first IP I bought under my personal name because I was looking to get my tax benefits, right? What I understand is if I buy my tail end borrowing capacity in a trust, that may allow me to buy more properties when the third property in a trust become positive cash flow. So for that reason, knowing the whole thing, I bought my first IP under my personal name, and I can give you those examples. I've pulled out all the links in there. So this was the first property. I've done all the data research, find out Port Kennedy is going to boom. There was no growth from the last 10 years, but everything else was lining up and a lot of projects around there. So I bought this property under my personal name, but here I've used the money from my owner occupier. I've got the equity out, use that equity to buy this property, right? So that property is funded by this one, and about like next one, now I know the third property when I'm gonna buy. If I buy under my personal name, most likely I'm not going to buy my fourth one because I wasn't looking my situation getting very better and my borrowing capacity getting better in a near future. So that point, I used a trust structure, and that was a family discretionary trust. I bought a property in 𝐁𝐮𝐲. Again, the 422 decent cash flow property, right? This property I bought for 380. Now that sits somewhere on 850K mark, so more than doubled in 4 years. This property I bought for 423, which is now sits somewhere around 750K. So rest of the whole portfolio I've built using equities from these two properties, right? So time to time I used to get the valuation from this property and fund my next property. So that was my 𝐁𝐮𝐲 property. Then I've used fund again from Perth property, bought in Mackay, again a different trust structure, because as Amol said before, I had a limited borrowing capacity at that stage. I didn't have a massive borrowing capacity. I want to preserve that. So what I have done is I created another trust structure and bought this property in Black's Beach. Again, I bought this property, and we bought a lot of properties for our clients in there. I bought for 560K. That last valuation came 760, so 200K up in 1.5, 2 years. That was my fourth property. Now, I didn't had enough borrowing going forward, and I was in a situation that what else I can do. So then I explore my super balance. Me and my wife combined sits somewhere around 120K at that stage, right? What I explore is there's a thing called concessional super contributions, where you can look into last 5 years of your, if your employer hasn't contributed enough in last 5 years, you can dump that 5 years super into your super balance and only pay 15% contribution tax. I was in like 37% bracket at that time. So it was a 22% saving straight away if I put that whole money into my super. So that year, what I have done is whatever savings we had, me and my wife, we dumped all that into SMSF, self-managed super fund. And from there, we bought two properties. We dumped 200K. I had 120K already there. So it becomes 320. Then I bought property in Epping. And this time I went with a commercial property. It was a small commercial. So again, you can buy commercial offices, all different asset class. So I bought this commercial property in Epping, which is rented out straight away. And then I had enough balance and I go with another property in my SMSF. That's again normal residential property, which is rented straight away. So I had now 6 properties under my portfolio. Now next is when I go for the next property, I discuss the whole scenario with my accountant that I'm going to do a rooming house. And then I got some suggestion that it's a positive cash flow property. It's a bit of different asset. Let's use a different entity. And I created a third family trust and bought a rooming house site for that. So that's where the construction is going to start. But by that time, we had all tax returns done, and I had a very good borrowing capacity in any particular trust. So I have decided to use one trust for multiple properties, because now at this stage I had multiple companies and trust structure. It was getting complicated for me. So I've used the same trust structure and bought my Burnie property, which is a recent purchase I've done. This is a property where I'm doing a major renovation. So I'm in Tasmania at the moment and monitoring this project and the Airbnb project, which I'm doing at the moment. So this is my 8th property in the portfolio in the same trust where we had one property before. Now, next one, again, I've utilized same trust. This is my Airbnb property, which I'm sitting at the moment, and we are furnishing the property for Airbnb very soon. So this is my last purchase. So that's how, from scratch, I built that 9 property portfolios using different entities. Awesome. I'll go presentation mode again. Amol, we want to cover this bit.
Yeah, so just before we start on that one, so in the current market, as I said, the properties are potentially going to be negatively geared. So lenders will still exclude the debt which are negatively geared by getting the accountant letter. And how are accountants going to give you the letter? So if you have funds sitting in the offset account, you have the option to move it into the trust, get it neutral geared, get a letter, and we can still build the portfolio even the property is negatively geared. Cool. walking through some scenarios. So scenario one, so one of the surgeons, she was on 400,000 and she purchased the property under the personal name. What happened? A positive get property, you will end up paying a huge tax on that. That's a basic mistake that people do. Then second one is, couple who were earning 200,000 bought an SMSF property, which was heavily negatively get with just 120K in the super. So they purchased it. They were not able to manage the holding cost. What happened? They had to sell the property and not utilize the full cycle and have that gains. Third scenario is contractor earning a decent income, but they purchased the property which was heavily negatively get. That negative get was sitting in the trust. He was not able to get any negative gearing benefit. Plus, accountant was not happy to give that letter. So it became difficult to scale the portfolio. So right structure, right property is very important. Cool. Which structure is right for you? So always discuss these things before any purchase under personal name or trust or SMSF. Always discuss it with your accountant. So if your marginal tax is on, it also depends on what your end goal is. But the rule of thumb, if you're under that 32% tax rate, first property, personal name is fine. If you are over 37%, trust makes sense. If potentially the property is going to be positive get in the near future, if you want that 15% tax rate, SMSF is the play. Is the property positively or negatively get? If it's a negative get, heavily negatively get property, go under personal name. If it's a positive get property, trust or SMSF wins. How much super do you need to have? So again, the ATO guideline is 200,000, but as I said, I personally started at 110,000, but it depends on what type of. So 150 can be risky. You need to make sure that you have enough buffer. 200 to 400,000 is the good starting point. 400,000 plus SMSF becomes a very strong option. Do you have low income beneficiaries? So if yes, trust makes sense because you have the option to transfer all the benefits or the income through the trust. If no, the trust loses its main tax advantage. What's your investment timeline? So if it's under 5 years, if you're planning to flip it or keep it simple, have it under your personal name. If you're looking for that long-term benefit, trust really works. And same for the SMSF. If you're going into that retirement phase and when you sell that asset, there is zero tax. All right, going to your Q&A on a high level. So can I transfer my existing property into SMSF? Answer is yes, but it's like you are selling it, your SMSF is buying it. You will potentially incur a CGT and the SMSF has to, pay the stamp duty and all, but it has to be a fair market rate. How much super do I need to invest in the property? Yep.
Sorry, Amal. For the first one, if I want to expand it, can I transfer my existing property to? Can I change my entity to any different entity? Right. The answer will remain same.
Answer remains same. Even if you want to transfer from your personal name to trust, it's same, but it's an expensive one because you're paying the CGT and the trust or SMSF is paying the stamp duty. That's the reason getting that right structure from the get-go is very important.
Expanding to this one, if let's say if someone has bought a property just on one name, right, and then adding another person who's a family member, let's say husband bought it, and the husband is going to add the name of the wife. So in that scenario, I do understand if it's going to under a trust, it will trigger the stamp duty, but just adding the name of the spouse, will it trigger the stamp duty as well?
It will, because you still have that portion which you are kind of transferring it to that person. So it will. So that's more an accountant question, but yes, it will trigger that.
Okay, thank you.
Okay. How much super do I need to have to invest in a property through SMSF? As I said, the ATO guideline is 200,000, but you have the option to start. But make sure that when you're purchasing the property, look at the cash flow and make sure that your mandatory contributions is able to cover that. If you need to put any additional contribution, make sure that it's not going to put you in that financial distress position. Can I negatively get a property inside a trust? So answer is yes, but again, the type of property you purchase, you are kind of holding that negative gearing in the trust, and it gets just carried forward from year to year. You will only get the tax benefit when you sell the property or when the property turns positively get. Plus, you want to make sure that your accountant is comfortable to give you the letter that this trust is self-sustainable. When we get the letter, we can exclude, the lenders will exclude the trust debt, retaining the main borrowing capacity in the other trust. What happens to the SMSF property when I retire? So you have, as I said, after you're in the retirement phase, if you sell the property, there is zero tax. Or if the property is self-sustainable, which rent covers all the outgoings, you have the option to just keep it. No issues.
Cool. Thank you. I think that was most of the common question which was being asked. I repeat,
so
there were
just a
many
quick
other
one, Manish, as
Yes,
well. I've got an ebook on my website as well. I'll put the link over there, which has for the SMSF. So it has all the details. What are the things which aid your profits? Which are the things you can go for? It's a pretty, detailed ebook, which people. I'll just put it in the link.
Sure,
The
no,
chat.
that will be great, right? So as such, we have covered most commonly a question asked, but I need to do a recap that there's another question which will be asked at the time of registration. Many of the questions which were very common, it has gone to the PFA, right? But there are still many more. We have some time. We can open the Q&A. If there's any questions, please feel free to ask, right? So instead of doing it on the chat box, and on the chat box, most of the question has been answered. I have to say thanks to a few of the accountants who are on board, and they are trying to help people to answer the questions. So thanks to all the accountants. It is only not one accountant. I can see there are multiple accountants asking that. So thanks for that. So let's open up the Q&A. If there's any questions, please raise your hand and please ask. Anyone want to go first?
Hi there. Can you hear me?
Yes. Can you start with your name, please?
My name is Eki, and I'm based in Northern Territory. I am a bit surprised when you gave an example of a young person, single, earning about 120, 130K. And in that example, you mentioned that if he borrows the property in his own name, his borrowing capacity will be exhausted by buying maybe one, at the most two properties, because banks can only lend you 5.5 to 6 times of your annual income. However, if he makes a trust, he can buy more properties. I am unable to digest this because ultimately, if I'm a bank, if I'm a lender, whether tier 1, tier 2, or tier 3, I have to make sure that whether I am giving the money to a trust or an individual person, how will I get my money back, and where is the more risk? And I have to abide by the 𝐓𝐫𝐺 regulations. Can you please explain that aspect a bit more in detail? Because this is something which is also asked by a couple of other people.
Yep. I'll take that question. So consider that when you're purchasing under personal name, that will get all the debts and liabilities are under your personal name. But when it's under your trust is the one who is holding the property. You act as a guarantor for that particular trust. Now, this particular trust A, becomes self-sustainable, which is your rent covers all your mortgage repayments and all. So that is self-sustainable trust, and lenders are happy to exclude that. So technically, it's not under your name. It's the trust who is holding that property. So lenders are comfortable to exclude that debt and treat the second trust as a completely separate entity, and you regain the main borrowing capacity which you had with the trust one as well. So this is how trust helps you to scale your portfolio. So, but the most important thing is that you need to have that asset positive kind of cash flow property in that particular trust for the lenders to exclude that debt. Negative get properties, lenders are not going to exclude it. Now, not all the lenders exclude the trust debt. There are a few lenders who will exclude it by an accountant letter. There are a few lenders who will take all the debts into consideration. For example, with the tier 1 banks, ANZ is the bank who will take all the debts into consideration, whereas your CBA and NAB, they are happy to exclude the trust debts, which are with the other lenders by getting an accountant letter.
I hope that answer okay for you.
Yeah.
That sounds, yep.
Fantastic.
Thank
Thank
you.
you.
Thank you. Yeah, Kavita, go
So
ahead.
yes, I have question regarding the family discretionary trust. So let's say, you know, because of what, like if the lenders, they say no, you don't have any borrowing capacity. And I was surprised to hear when Dinesh mentioned that his borrowing capacity was maxed out under personal name, and he bought property 4 and 5, I think, under the family trust structure. So, and Manish also mentioned in the chat that some that lenders don't look at the borrowing capacity so closely as they do under a personal name. But I recently have been, trying to get some information on this, and I have been getting what the information that you have providing is very different from what I have learned from the bank and mortgage broker. So,
Yes.
what is from where are we getting this discord? Because, and secondly, if the trust, let's say the property is under construction, and once the construction is complete, it will be able to sustain itself. But even then, the bank or the lenders, they are not uh, approving under a family trust. So I'm getting very contradictory information
Yeah.
from this
See,
platform and the other outside.
so I'll
So
cover
that's
my
why I'm confused.
I'll cover my part, Amol, before you jump in, right? So
Mhm.
again, whenever you're looking to buy in a trust, as per my understanding, I'm not a broker, you need to have your own personal borrowing capacity first of all, right? If I say I have 700K borrowing capacity, I bought property for 700K under my personal name, and now I don't have any borrowing capacity left, then no one can, like, I think no banks will give you the loan, right? Banks will give you the loan when the trust, if you buy a property in a trust, and trust is positive cash flow, and you can get a letter for that. So in that scenario, when I said I bought my fourth property, like at this stage I had a borrowing capacity to buy one more property. When I bought this property under a trust structure and I declare it as a positive cash flow property, then only I was able to buy the fourth one, right? So that's a scenario. If I buy, I exhaust my borrowing capacity buying Perth property, and I don't have a borrowing, then my journey is stopped there, right? Amol, can you clarify what I have explained here?
Yeah, so your borrowing capacity under trust is always based on your personal borrowing capacity. The common question that a lot of time I get is that, can I exhaust my personal borrowing capacity and then go under trust? Answer is no. You need to have your own borrowing capacity because, as I said, under trust, in fact, your borrowing capacity goes down with tier one banks because they don't take the negative gearing into consideration. So you need to have enough borrowing capacity under personal name for you to go under trust. So that's the reason having that right asset planning is very important. And see, I've had clients that they have sold their assets which are under personal name to free up the borrowing capacity and then restructure the whole portfolio to scale it.
But yeah, Kavita,
Okay,
if you were
understood.
still,
Yeah. I think I have understood. I have much more clarity now.
yeah,
Thank
so
you,
but
all.
still, if you have a question, just ask us directly, and we will be able to answer you after that,
Sure.
right?
Thank you. Thank
Sagar, if you want to ask your question.
Yeah, so my question is pretty fundamental. Like, where do I start the discussions? Like, should I go to the buyer's agent first, go to the accountant first? Your objective there is just to get some modeling done as to what structure would fit in, given where I am financially and what my borrowing power and stuff is. So, who is the
Yeah.
right person to begin with?
See, I'll give my perspective. I see, there, like, if you're going with a good bar agent, that eventually they will recommend you accountant and a mortgage broker anyways. That's the same thing with any broker or a accountant. If you go to them, if they're good ones, they will recommend you to a good other professionals, right? And the other option is to go to financial planners, which they give you to give you the overall picture how to budget everything, right? So that is what I would say. But you can reach either if you talk to Amul, we get a lot of clients from Amul saying they have this borrowing capacity, 700K borrowing capacity, or what they're buying in this. Can you help buying a property? And we help them, right? On the other way, if you come to me after giving what we can do for you, we may recommend you to Amul that okay, now we tell you that's the whole the idea how we can do it. Now talk to Amol, or Ankur is on the call as accountant. Talk to Ankur for your structures, right? So
Okay.
this is the approach I would take. But any good professional you go, they can direct you in the right direction. Amnish, you want to
Alrighty.
add anything?
Yes, just to add on this one, if you want to go for the sequence, it's always advisable or always good to know, understand how much you can borrow, right? So at that point, you get in touch with the broker. Broker will let you know, yes, based on your income, based on your liabilities, this is the X amount you can borrow. At that point, you don't have to wait for the pre-approval. In my opinion, things can start in parallel. You can get in touch with the broker, or sorry, with a buyer's agent like us. We can help you out, and the pre-approval can happen in parallel. So you can save a little bit of time over there. Why I'm saying this is important, because let's say your pre-approval or your borrowing as per your broker, it says that you can borrow up to, let's say, 800, right? And we are hunting a property for 600. Then it doesn't make sense that because you have a borrowing, right? But if you know you have a right borrowing, we can find you the right property. On the other side, let's say your broker says that you can only borrow for around 450 or 500. Then it doesn't make sense for us to start looking for the property which is over that amount, right?
Yeah.
So in short,
Alright.
brokers
Yeah.
will be good.
Okay, fair enough. Because it's almost a chicken and egg problem. Because depending upon your structure, you may want to go to a different borrower as well.
Yeah. Yeah.
Like
See,
different, yeah.
the good thing is the high level information you can talk to anyone. For detail, I think first step is to go to the broker, get the borrowing capacity in all the entities you
Mhm.
can have under your personal, under trust, or SMSF is an option for you, and then you start building from there. Right?
Righty. Thank you so much, sir.
Thank you. Is there any other question we have here?
I have a question, Chandrasekhar this side.
Mhm.
This is regarding, let's say if uh, I have a trust and I have some money in my offset account, which I got through equity. So, what's the best way to transfer that money to my trust? Is there something which I need to consider before doing that, or can I just simply, get it transferred, or do I need to loan it to the trust?
Well, you're putting it in an offset account, so not using that funds. So you have the option to transfer it and put it in the offset account. Again, check with the accountant, but you can make sure you have the offset account and just you can park it over there. And it will also help you for the property to be neutral gate if it's really negatively get. So you have that option.
No,
I think the
sorry.
question is a personal property where he got the equity out.
Yep.
Now that
Yeah.
equity is sitting in an offset. He's looking to buy a property in a trust structure. How to transfer that equity to the trust account, right? What's the way?
Yeah.
I think it's more accountant question.
It is accountant question, but you need to make sure that if it's a property under personal name and then you're transferring that equity, it is a separate split because you cannot claim any negative gearing benefits on it because you're kind of loaning it to the trust. So again, check with the accountant to make sure that you have the right structure.
Sure. One more question. So just wanted to check regarding family trust and business trust. Like, which one is best in what scenario? If there is a quick answer.
So see, property cannot be bought under the trading entity. It has to be a non-trading entity. Okay. But again, check with the accountant. That's more an accountant question.
See, again, Chandra, I will give you a bit of idea of like the business what me and Manish running. That's a different unit trust entity where we are running is a business trading, and if you buy in the same entity, you're exposing to the risk. And anything goes bad with this entity, you have an asset in there as well, which is exposed to the risk as well, right? There might be a possibility to buy here. Like if you don't need a lending, you can buy straight away without a lending as well, right? So
Okay.
there are options there, but it's generally recommended to have another non-trading entity where you can buy the assets, right? So
Okay.
that you create another family trust, and again talk to the accountant what's best suitable to you, right? So with these trading entities, I'm not doing anything in here. I'm just keeping
Okay.
it separate for the business,
Okay.
right?
Understood.
I do have a last question to Amol.
Yeah, go ahead.
Yes, Ramesh.
Yeah, currently I can go and buy say 600,000 worth of property, and I'm planning to get my first IP in my personal name, so I'll exhaust that 600, and after that I would still have 600 left if I want to go and buy. But my long-term growth plan is definitely, like keep accumulating the properties.
Mhm.
So what would you suggest for my second IP? Is it better that I go in a trust so that, like my long-term goal, which is accumulating more properties, is more viable, or
Yep. So
go?
say hypothetically, let's say that you have your borrowing capacity of 1.2 mil. You purchased or exhausted 600,000, which is under personal name. So tomorrow you will be extracting the equity from this property as well. Okay, so you are kind of further exhausting the borrowing capacity, which is under personal name. And under trust, your borrowing capacity actually goes down with the tier one banks. So from 600,000, potentially it'll come down to 450 to 500,000. Now, in the first property, which is under your personal name, if you're going to extract, say, another 100 to 150K, this property, which is going to be under trust, your borrowing capacity is going to go further down. And we are not going to find the properties which are for 200 and 300,000 good quality properties. So it's important that you retain and maintain a good borrowing capacity under trust. You always have the option to go under your personal name whenever you want to, but you cannot go whenever you want to under trust. So recommended that it is important that whatever your borrowing capacity is, we make sure that you purchase the right asset and go under trust if it is going to impact your future purchases.
All right, thank you.
Is there
any more questions? Looks like it's been silence, but I will ask one question, pretty much that's about the house rent package, right? We touch base three structures: personal, trust, and SMSF, right? So we know house rent packages we can buy under the personal name. What's your take about buying the house rent package for under a trust, as a family trust, or a SMSF?
So short answer is yes, you can buy it under it has to be a one-part contract, especially under SMSF, but under trust, it can be a separate contract, so no issues.
And when you do the one-part contract, there can be an additional cost because someone gonna fund you during the construction, right? So generally, it's a bit high. Like for if you're going SMSF under home and land packages, comparing to other entities, the cost could be a little higher. That's what my understanding is.
Yeah.
Correct, Dinesh. And not to be surprised, people are hearing this one that for house rent package under one part contract in SMSF, not to be surprised, the cost can be even higher by 10%, right? So that's not to be surprised. If you're going to go for buy a house rent package in SMSF, if the purchase price is 10% higher, that means you are already paying way higher to acquire that property. So think about it before you take a step. Cool. That's the question from me. Any more questions from the
Dinesh, Manish, can I ask one question? This is
Go ahead. Go ahead.
I have one question related to SMSF investment. Let's assume we have all the minimum funds and all. If someone someone might go, okay, how to give this one? If someone have planned, like say after 5 years to relocate somewhere else or whatever, leaving the Australia or whatever, but they have confirmation, okay, next 5 year there would be incoming in my SMSF through my salary or whatever is the reason. Is this still advisable, like we can for 5 year type kind of time we can still go with the SMSF, and the person is Australian citizen, that we will get only the SMSF after 65, not SMSF, sorry, super fund eligible to get it after 65. So is this still advisable to go with SMSF for 5 years?
Varun, I think this question has came up during the registration as well.
Yeah.
If not wrong, I have put this question on the thread on the PFA as well. But anyhow, in terms of Dinesh, can I take it?
Go ahead.
Right. So in this one, the way I would say is that we need to do a structure. We need to do a proper planning. The property which we're gonna purchase, we need to ensure that it's not too much negative, right? We need to plan in a way that in 5 year horizon, the property should become at least not 5 years. Should be even before that. The property should become neutral, right? Why neutral? After 5 years, if you have a plan to go overseas, if you let's say I don't know, but I'm just assuming someone is not physically fit, right? They lost their job, they no medical fit.
Yep,
It will
yep, yep,
impact the employee contribution,
yep,
right?
yep,
So when
yep.
the employee contribution is been impacted, that means the repayments, the negative component will be impacted. So in 5 year time, if the property become neutral, then for you,
Yeah.
there will not be an extra burden that if you want to keep that property, the rent will be able to cover up, right?
Yep, yep.
So that should be the horizon. But remember, in SMSF, whenever we have to plan it, we have to plan with the horizon that it's a long-term purchase.
And if in a worst case scenario, yeah, it could be a leaving country, or it could be leave the job and doing something where super contribution cannot be done. It, and if that property in next 6 year has been, or 5 year has increased quite, like say 300K or 250 to 300K, it's advisable to sell it. And then what would be the implication of selling it? At least we got the benefit of 300K.
Correct. See, if we sell it, the beauty in SMSF is that, if I'm not wrong, the capital gain tax, which we always talk about, let's say if you bought a property under a personal name, if we hold it for 12 months, after 12 months, we have to pay a CGT, but their CGT, which is on the profit, there will be exemption of 50%. When it comes to SMSF, if we sell it after 12 months, the CGT component will be lower. So we only have to pay 10% CGT.
So
Right.
it's still, if someone have some kind of this kind of lock plan in 5 year, if we are earning, let's say 250K or something, whatever growth, yeah, let's assume something 10% growth, and let's say 200 to 250K in 5 year time, then it could be a good, if someone has exhausted all his personal
I
borrowing and
think
all.
it's a still good
Correct.
idea, right? So you pay, for example, you made 300K out of that. You say 700K property become $1 million property, right?
Yep, yep,
You're paying only 10%. In
yep,
personal, you can pay up to your whatever your tax brackets are at that
yep,
point.
yep.
In here, you're only paying 10%, right? So the 10%, you may end up having a handsome deposit, handsome profits in there. But picking up right market is very important,
Yeah,
because
yeah,
you're
yeah,
looking at short term growth.
yeah, yeah,
Sometimes when buying in SMSF, we generally sometimes look, okay, short term doesn't matter because you can't get equity out from the SMSF, whereas long term is more important, right? In that case, you try to get somewhere where you get a short term growth as well, so that in the case if you have to sell the property, you're still very profitable there, right?
yes,
Again, every scenario is like, this is a bit specific scenario, good to run through some good professionals, right?
yep,
Amol,
yep, yep.
want to give any advice on top?
Not really. You covered all the
You
things.
covered it. Thank you.
Okay.
I
Just
think
last question, like many buyer, like you say it's a SMS of property. When it comes to as a customer, we come. Do you have a separate category? Let's, okay, this property fits for the SMSF kind of structure, and this is for the personal or trust kind of structure. Is this really something happens?
See, we covered that. I think the personal, you can, like, I'm doing some projects where I'm ripping off the whole house, doing the renovations and all that.
Yep.
So they're more suitable for personal or
Okay,
trust,
okay, okay.
right?
Got
So
it. Okay.
in SMSF, we try not to buy that old that
Oh,
you can't put a granny flat at the back. You have to have your own cash. Basically, there's a bit of restrictions there under
okay,
SMSF,
okay. Got
right?
it.
Whereas under personal and trust, there's no restrictions like that, right?
Okay.
The like basically, when like in SMSF, we generally buy newish one with no renovation required, and they can hold for longer because you're selling the property for after retirement. If you're say 40 years now, selling the property after 60 years, the property should be in a good condition for next 20 years. So
Yep,
better to
yep,
go very,
yep,
not very old properties,
yep,
right?
yep. Now it's all, yeah, it's answered the
Awesome.
query why it's a
Thank you.
specific. Thank you so
Yeah,
much for this answer. Yep.
very good.
So
Vivek, I think last question before we wrap
Yeah.
up.
yes, Vivek,
Vivek, go ahead.
I just have a quick question. Like, if I'm trying to invest in SMSF, it's like around 15 years range, a good investment, like a 15 years old property, is it good? And secondly, like when you say like low maintenance, what does that mean? Does it mean like additional features like swimming pool or something like we shouldn't have, or because that will yield more rent, right, if we look at the longer term? Or
Yeah.
like low maintenance, does it mean like you do some renovation, right? So if you can just give me some idea.
See, I'll add my perspective, then I'll ask Manish or Amol. So
Yeah.
basically, when we say low maintenance, for example, but I have bought my property here. See, with the pool, it's very optional. I would say it's not a very big messy. It's just a maintenance cost which you can bear. But generally, I avoid buying properties with the pool. The reason being is you may get a $50 extra rent, but you may pay the $50 maintenance over the long time, right? So it's somehow it doesn't help much in the end. I've seen few clients bought with a pool. In the end, like they don't see 2 years no issues, and the third year this motor is gone. So the motor only costs like $2,000. Then whatever $50 extra you're getting over the last 2 years, it's all gone in a one go, right? So but generally, like for example, in SMSF, like decent 422s where you don't have, I literally like properties like these. This is what my Reno project is. It's not recommended to buy in SMSF, right?
Yeah. Okay.
Where you have to spend 20, 30, 40, $50,000. And one thing to keep in mind, you won't, one thing is manufactured equity where you are putting some renovations, uplifting the value. So I'm putting $1, getting $3 back. I'm putting $30,000 for renovation, valuation up by 100K. In that scenario, I get the equity out to fund my next project, right? These kind of things you can't do in SMSF, right? It's regulated. You can't change the state of the house. You can't just add things in there. So basically, it's not advisable to buy something like this, right? So Manish, you want to add anything in here? What I've explained?
Something similar, right? So let's think in another way. We do the reverse engineering. Every single person, based on their borrowing, they will have a particular, based on the income or based on the employer contribution, they will have a borrowing. For example, the borrowing comes to be either 600 or 700, right? Now, what we need to understand is that under 600, where we can buy, what type of asset we're going to acquire. Definitely, property prices are going higher. With properties under 500, 550, 600 won't give us an option where we will be able to buy newish property, which means we will end up buying properties which are a bit older. Older means it can be 30, 40, 50 years old, right? At that point, what we need to consider would be when we do the BNP, will this property require some maintenance? For example, if the roof needs some work, if the flooring needs some work, if the property needs some work, who gonna fund that? That particular amount will not coming from the loan. So your super or SMSF, which has been set up, that has to fund that particular renovation or the uplift, right? So which means your balance will go down. So as in the other way, if you have a borrowing of 700, if you can buy a younger property, which is like less than 5 years or 10 years, or a property which has solid bonds, which doesn't require a maintenance, that will be something which we will prefer to do it.
Yeah. Okay.
Yeah.
Thank you.
I think we have covered well. Thank you, Amul, for being here, answering everything. If you missed any questions, please feel free to reach out to Manish, reach out to me. Amul's number is on the on the screen there as well. Was on the screen. I'll share once again just to give a last side. So that's my number, that's Amul's number, and that's Manish information. You can reach us on directly. You can call us or leave the inquiry on our website or message us, whatever suitable to you, and we'll definitely get back to you and answer your things. Right.
And last thing is that the recording is going to be shared tomorrow at the next. We will also share the contact numbers in the recording by the email, or it will be on the PFA. Last request: if you like the webinar, there's no harm to say thanks on the PFA or to the people who are speakers. Especially, I want to say thanks to Amol. He took a very valuable time to come on the evening. So thanks, Amol, as well.
Thank you, Manish. Thanks, Dinesh.
Thank you, everyone.
Thanks, guys. Have a great evening.
Thank you so much. Appreciate it, guys. I really love your all webinars. Thank you. Thank you. Thank you.
Thank you.
Thanks, Arjun. Dinesh, can you stop recording?
Yes.
I think it's good that most of the people were active because they are.
I think we can drop off. I think the recording is there, right?
And thanks,
you.
Ankur.
Take care. Thank you, Ankur, bye, for joining. Take care. Bye.
Thank you.